Maruti Suzuki's revenue jumped nearly 28%, but profit fell. Think about that carefully. India's biggest car company sold more, earned more revenue, delivered strong volumes, and still the bottom line disappointed. Bottom line mean profit after tax. This is not just a result update. This is a warning because in stock market, revenue is the headline, but margin is the truth. Volume shows demand, but profit shows power. And today, Maruti's result is asking one brutal question. If the company is selling more cars, why is the market still punishing the stock? Many retail investors will look at the revenue growth and say, what is the problem? But the market is not looking at only sales. The market is looking at cost pressure, margin compression, other income collapse, expectation, valuation, and future earning quality. And that is where the real story begins. This is analysis and not an advice. Let's start with the headline number. Maruti Suzuki reported revenue from operations of around rupees 52,449 crore, up nearly 28% on year basis. On paper, this looks powerful, but net profit fell to around rupees 3,591 crore, down from about rupees 3,857 crore last year, and also below analyst expectation of around 4,138 crore. So the company sold more, but shareholder did not get proportionately more profit. That is the first red flag. In businesses, sales growth is not enough. The real question is how much money remain after cost, expenses, taxes, and non-operating items. And in this quarter, the answer was uncomfortable. The first major reason was raw material cost. Reuters reported that Maruti's raw material cost surged nearly 51%. That is not small pressure. That is a direct attack on profitability. Cars are not software products. Maruti needs steel, aluminum, rubber, plastics, electronic batteries, logistic and imported component. When these costs rise faster than companies' ability to pass prices to customers, margin get crushed. This is why revenue can look beautiful and profit can still look weak. More cars sold does not automatically mean more wealth created. If every car earns less profit, volume growth became less powerful. But raw material cost is only the first layer. The second damage was margin compression. Reuters reported Maruti's operating margin shrank by about 270 basis point to 7.2%. This is the number serious investor watch very closely because margins tell you whether the company has pricing power, cost control, and operating leverage. A fall in margin means the business had to absorb pressure, and when a high quality company shows margin pressure, the market does not wait politely. It immediately starts questioning future earnings. This is why the stock reaction can look harsh even when sales are strong. Retail investors saw revenue growth, the market saw margin damage. Retail investors saw Maruti brand, the market saw earning disappointment. Retail investors saw cars moving, the market asked how much profit is left. Now comes the hidden point many investors miss, other income. Profit is not only made from selling cars. Companies also earn from investments, treasury income, and financial assets. This quarter, other income reportedly dropped 67.3%. Economic Times also linked the profit pressure to mark to market losses in bonds. This matters because when other income falls sharply, reported profit get hit even if operating business is not broken. Many retail investors never check this line item, but institutions check it. Analysts check it, the market check it. And this is why just reading revenue and PAT is not enough. You need to understand what created the profit and what destroyed the profit. Now, the fourth reason is product mix and volume quality. Maruti's overall vehicle sales, including export and Toyota supplies, rose nearly 11.8%, while domestic sales rose 3.7%. But small car sales declined 4.3%. This matters because not every vehicle give the same margin. Selling more units is good, but selling the right mix at right margin is more important. If growth comes with higher cost, lower margin, different channel mix, or weaker profitability per vehicle, then revenue growth can hide pressure underneath. This is the exact difference between headline growth and earning quality. Headline growth impress beginners, earning quality impress serious investors. Now let's come to the biggest reason the stock corrected from higher levels. That is expectation. This is where most retail investors get trapped. The market does not compare Maruti only with last year. The market compare Maruti with what was already expected. Before results, investors were expecting strong performance, better profitability, and clean earnings. But when profit come below expectation, the market punished that gap. The gap between expectation and reality is where stock price damage happen. A company can report revenue growth and still fall if the market expected better margin, better profit, or better guidance. This is why good result and good stock reaction are not the same thing. Now understand the bigger picture. Maruti is not a weak company. It is still India's largest passenger vehicle player with massive brand trust, distribution reach, manufacturing scale, vendor ecosystem, and export capability. It also has around 1.9 lakh pending customer orders, and Reuters reported dealer inventory of only around 12 days. That means demand is not dead. This is not a business collapse story. This is valuation, margin, and expectation story. And that distinction is very important. A weak company falls because business is dying. A strong company falls because expectations were too high, margin disappointed, or valuation need resetting. Maruti's case is closer to the second category. The company may still remain strong, but the stock can struggle if earnings growth does not justify the price investors were paying. This is the painful truth of market. Even great companies can become bad investment at wrong valuation. Famous brand does not protect you from margin compression. Market leadership does not protect you from cost inflation. Strong sales do not protect you from earnings disappointment. Now, what should investor track from here? Not only sales number, sales are the only starting point. First, track margin recovery. If operating margin improves, confidence can come back quickly. Second, track raw material cost. If input cost cool, profit can recover. Third, track product mix. More profitable model can improve earning quality. Fourth, track other income normalization because treasury losses can distort reported PAT, profit after tax. Fifth, track whether demand remains strong after the current order book convert into actual sales. And most importantly, track valuation because Maruti can be a strong business, but stock still needs earning growth to justify a premium price. Final takeaway: this result did not prove Maruti Suzuki is finished. It proves something far more important. Revenue alone is not wealth creation. Sales create excitement, margins create confidence, earning create value, and expectation decide the stock price. So when you see a company saying revenue is up by 28% but profit is down, don't stop at the headline. Ask the harder question: why did more sales not become more profit? Because that answer tells you whether the stock is facing temporary pressure or a deeper valuation reset. Maruti is still a powerful company, but this result is a reminder that in stock market, popularity is not protection, scale is not protection, brand is not protection. Only earnings growth, margin strength, and valuation discipline protect investor. And that is difference between buying a great company and buying a great investment. Thank you very much. Make sure you subscribe the channel and like the video. Thank you. See you in the next video.